Hello everyone, my name is Matt Cincerello, and I'm the owner and managing partner here at Unique Accounting. You can learn more about what we do by visiting us at our website, u-uniqueaccounting.com. And while you're there, I recommend you check out our free stuff page where you can read our blog and also download free content like the top 10 cash flow mistakes that can cripple business. And if you're wondering what I'm drinking, today's beverage of choice is a South African cab. I'm shooting these videos back to back. It's been a long week and I'm not waiting to do it. And I think I deserve a little glass of wine. And if you notice, my cup is bearing the hashtag #MakeTodayCount. This is the slogan for my Best Friends Foundation, which is a close and personal not-for-profit that I'm a board member of. A link will be provided to a form that you can fill out if you or someone you know is dealing with the impact of cancer in their lives. So let's go ahead and jump into today's topic. And today's topic is common mistakes that we find made by other accountants for restaurants. So I'm not here to talk about general ledger coding preferences and other small ticky-tack things that really come down to personal preferences. I'm here to talk about the big ones, key things, important things that we see other accountants missing or overlooking that are pivotal to your business. So some of these include missed tax credits, like the FICA tip credit. The FICA tip credit is a credit you get for the Social Security and Medicare taxes paid on tips you report to your wages for payroll purposes. It most likely means you can get 100% credit back on all those taxes. We have a whole video on this. I recommend you checking it out to see if you're getting it, and if not, you should give us a call. There's also the R&D tax credit. While it's not as big as like a brewery and other industries, in the restaurant industry, you are doing a lot of new recipes, and some of these activities qualify. So am I going to save you hundreds of $1,000s with the R&D tax credit? No, but it could be a couple $1,000s. And what's great about it is you get to deduct it when you file your payroll taxes. So once a quarter, you can feel a little cash flow bump just from that tax credit. There's also a credit for putting a 401k plan in place. So in the initial year of launching a 401k plan, the IRS will give you a credit for doing that. And there's also the work opportunity credit for hiring veterans and disabled persons. And there's also other certain targeted groups are in that credit, but those are the most common that we see with our clients. Other common mistakes, the wrong accounting format. We see this 100% of the time because we have yet to get a client from us that was on Xero, which means they're on some type of version of QuickBooks, and QuickBooks cannot handle the accounting format for your restaurant. Your restaurant should be using the 13-month calendar, and QuickBooks cannot handle the reporting for that. And they can't segment and look at your cost of goods sold the right way in terms of tracking food versus food cost, food costs for food sales, beverage versus beverage sales, and etc. In order to do that, you have to export out of QuickBooks and do everything in Excel. Whereas in Xero, we can do custom templates and do that all within the software. There's also the wrong categorizing for purchases and labor. They may have a general purchases account, but they're not segmenting the type of purchase with like the type of beverage you're buying, or food if it's dairy versus another element of the food. Same thing with labor. They'll generally put labor into like a direct labor bucket as opposed to front of house and back of house and management labor. So you can actually analyze your labor appropriately on a period by period basis. Another set of common mistakes is not connecting your systems. 100% of every client we've taken has a paper and very manual process, which astounds us because your industry, the restaurant industry, is one of the best for connecting systems because your sales process relies on a POS. And if you're using delivery vendors, again, you're using the web to do that. There's no reason why you should be downloading reports and giving them to your accountant so they can hand type your sales activity into your accounting software. In order to do that, you can't do it daily. It costs way too much. But when you can integrate it and have it done automatically, now you can get daily sales data into your accounting software and see things on a daily basis, a weekly basis, as opposed to just once a month. There's also typically no time connection into payroll and no payroll connection into the accounting software. So again, we see clients over and over again where their employees are tracking time and then they hand type it into the payroll program and then they process payroll and they're not doing direct deposit, they're still doing checks. And then the payroll program doesn't connect with QuickBooks or Xero in order to automate the recording of it. Everything is done manual. With us, it's the opposite. We connect your time to payroll. So all you have to do is double check it or tweak it. And we connect the payroll to Xero, so that's automatically done, keeping your costs down. And the last two mistakes relate to debt and taxes. Really, really important. And they're really overlooked. And most accountants don't ask these questions and think about this. But most accountants blow their clients' debt covenants. If you don't know what I'm talking about, it's because you haven't had debt yet. But when you borrow money from the bank, they have certain requirements you have to do to comply with getting that loan. It could be a personal guarantee, it could be collateral. And there's typically ratios for the performance of your business that you have to hit in order not to get in trouble and lose the loan. We have seen so many accounting firms focus on just saving taxes because they want to look so good to their clients.
It's like, oh, I came up with this great tax saving idea.
Well, guess what? You got them kicked out of their bank. Pat yourself on the back. It really, really angers me, and I hope you can see my face, because they are so focused on taxes that they will destroy the financial stability of your business. They will destroy your working capital. Saving taxes is great. It really is. But your working capital is the lifeblood of your business. Don't wait for your accounting professional to ruin it for your business. Then there's a concept of not blowing covenants, but prohibiting the ability for you to get debt. Again, they're so focused on taxes that they'll take a year where you've made no money and reduce it to zero or generate a loss for you, so you pay no tax. Does a bank like that? Hell no. Why would a bank give you money to help you grow your business when you make no profit? Think about it. Stop focusing on just taxes. You have to have a holistic global approach when planning your business. You have to have a tax strategy that lines up with your business strategy. And if your business strategy says we don't need debt next year, sure, let's take advantage of taxes and keep tax down to save some money. But if you're looking to grow and you know you're going to need working capital next year and a bank has to help you, oh, you better not do that tax strategy idea. You better focus on showing profitability and good, steady cash flow numbers to get that loan. Well, thank you for listening to common mistakes that we see from other accountants. If you appreciate our advice, please remember to like our video and subscribe to our channel for future content. Until then, remember, don't conform, stay unique.